Hi everyone, it's Conrad Bobilak here, CEO of Investors Prime Real Estate and best-selling author of Australian Real Estate Investing Made Simple. Today's video is very important because it's really essentially the main thing you have to really conceptualize in your mind with crystal clear clarity on what is your objective with real estate investing. Why are you doing it in the first place? Because I can tell you real estate investing is a lot of paperwork. There's a lot of time where you have to be really patient. There's a lot of times where you're just waiting for stuff to happen with valuations, loans. So what is it that you're really after? And really for me and for a lot of investors, it comes down to being very specific about how you can generate income on a consistent basis that can add to your lifestyle and change your life. And what I've done is today is I've prepared a presentation about how you can generate an income of $78,000 to $100,000 passively. And the word passively is very important because this whole reason why we do real estate is because it's a passive way of creating income just with owning 5 investment properties. And I'm going to show you exactly how this works, how we do it with our clients, and how they're able to get equity out of their properties and buy other properties, and also how they can generate passive income from the rental of their property portfolio. So thank you for joining me today. Personal disclaimer is I haven't met you. I'm not aware of your specific financial situation or circumstances or financial risk profile. This information is purely for educational purposes only. And if you do anything and you end up taking any recommendations from this video, it's at your own risk, and seek independent financial advice. But also make sure that you are seeking advice from people that have achieved the results that you actually want, not people that are just sitting there selling financial products, getting a commission, and they're dead broke, which is majority of the financial planning industry. Why should you listen to me? My background, for those who have never seen me speak before, I wasted 4 years of my life playing pool and drinking beer at the tavern at Monash University with international students, wasting my time. Nearly did an MBA, more bad advice, but I decided, you know what, I think I like making money. So I got into financial planning with Australian Uni Funds Management because I thought financial planners actually know how to do a financial plan, which they don't. All they do is sell products off of recommended lists, and they're all dead broke. So I left that industry, got into banking. My passion has always been real estate investing. It's the only reference I've ever had of people actually really making a lot of money, and obviously running businesses. So my background is mortgage broking. Definitely, I'm a real estate agent right now in St Kilda, right here in my office in Alma Road. And also the most important thing is that I have a multi-million-dollar property portfolio in Melbourne. I'm investing every day, refinancing, getting valuations on my properties. So I've got my finger on the pulse. And not only that, I help others to set up their property portfolios correctly. I've also worked for NAB and Medfin and had a mortgage broking company of 28 staff and 13 mortgage brokers. So predominantly my background has been lending and finance. My book is, which is Australian Property Finance Made Simple, has got #1 bestseller. You can get it on Amazon or jump onto my website, which is bookonfinance.com.au. And also my new book has got #1 as well, which I want to thank everyone for buying. You can buy any bookshop, Amazon, realestatemade.simple.com.au. On Amazon, it made #1 bestseller in the real estate investment category, which my book was placed in, which is really cool. And also my finance book was #8 that week as well. So that brought up my finance book. I think people are buying both books. And look, I can tell you, the thing about knowledge, guys, is people talk about ignorance being bliss. Let me tell you something. Ignorance will send you broke to the poorhouse. And this is why majority of Australians end up dead broke at 65. Ignorance is not bliss, okay? The sooner you get financially educated, the sooner you'll take control of your financial life. And then the funny thing is that people say, oh, I'm too busy to work. Well, let me tell you something. Are you too busy at work to save 10 years of your mortgage and 150 grand in potential interest that you're paying to the bank? I mean, the best thing you can do in your life is take a week out of your life, read these books, and actually restructure your mortgage and save yourself 10 years of your mortgage. People say, I'm too busy to read. Well, you're going to end up dead broke. Just make sure you don't blame anyone at the end. That's my thing. So if you're cool with it, no problem. Reading books and meeting people that are successful is the key thing that's going to take you to the next level. Remember, your net wealth is always determined by your network. which are people that you interact with. So there is no shortcut to education in life, guys. You're either going to get educated or life will educate you painfully. You're going to pay the price ultimately. Now, I've chosen 78 grand because that happens to be the average annual full-time employment earning in Australia right now, which is 78,000 per year. And that's encompassing all different industries. Obviously, if you're working in WA in the mining industry, you're probably on 200 grand a year. You know, if you're working in Tassie in a cafe, you're probably on 40 grand a year. I mean, it's all relative. But what I've done is I've chosen just an average income of 78,000 and I've enlarged it to kind of 100,000 to capture more people and more of the percentile to be kind of representational of what the average person is earning, just to give you the actual concept behind it, to show you the mechanics of how it's possible to live off your property portfolio and how these people are actually doing it. And I must apologise, by the way, I've got a bit of hay fever today. Melbourne there's high wind in Melbourne at the moment. There's pollen, flowers are pollinating everywhere. I'm from Europe, so I have an itchy eyes and itchy throat and a bit of a runny nose, so I do apologise for that. Now, building your journey through wealth is very difficult because no one's really teaching it correctly, and the people that have done it that I've met, they have no incentive to teach. They're just too busy living life. And I'm 44. At 50, I'll be shutting down all my client contacts and I won't be teaching anymore. I maybe will do another book or two. I will be writing 5 books, by the way, before I'm 50. But at 50, I'm going to be traveling the world with my family, living off my massive property portfolio, spending 6 months in Tuscany and 6 months in Melbourne, and maybe get a penthouse in New York, you know. And so eventually, for me, it becomes a trade between time and money. And while at the moment, I actually want more money because I don't need the money, but I take the money because I want to buy a lot of shit. Eventually, it'll come to a point where I'll just value my time more than trading time for money with clients and interacting with people in the industry. So when that point comes, which will probably around 50, I'll stop teaching completely. So while you can, learn from people like myself who are actually doing it for real every day. And I did retire from my property portfolio. I left Medfin and I was on a passive income of about $160,000 per year. So I can definitely teach you how to get there because I've done it myself. Never take advice from people that haven't achieved exactly what you want. And I use the analogy of powerlifting. I've been doing powerlifting now for 20 odd years. My 1 rep max for deadlifts is 350 kilos. I remember I couldn't lift 60 kilos off the ground. I remember going to Mike's gym in Dandenong and I could not deadlift 220 plates and Olympic bar. An Olympic bar is 15 kilos plus the 2 nuts are 2.5 kilos each. And I was 6'2", my height was 74 kilos. I was really skinny growing up. And, you know, and I've progressed over that. But how I've progressed over 20 years is a couple of things. I had a very clear plan of what I wanted to do. Powerlifting is based on 8 weeks volume training. I had coaches, both nutritional coaches and strength coaches. And these were Olympic weightlifting and powerlifting champions, national champions. The number one thing is, if you want to deadlift 100 kilos, get advice from someone that's deadlifting 100 kilos, right? Or more, preferably 200. What you don't want to do, okay, which is so stupid that I see every day, is get advice from people that do not have the results that you want. So if you can't deadlift 100, don't listen to people that can't deadlift 100. Or if you want to deadlift 100, don't get advice from someone that's deadlifting 50. It's irrelevant. Their advice is irrelevant. So before someone gives me advice, I qualify them, whether they have the right to give me the advice from a perspective of actual results. So if someone has 5 properties, then definitely, and you got 1 property when you get to 5, that's a good person to listen to. If someone has no properties and you've got 3 and you want to get to 10, their advice is completely useless, irrelevant. Okay? So forget about it. Why even ask those people? It's redundant. And this is what people do. They ask their accountant who's broke or the financial planner who's selling products off a recommended list, financial products. By the way, real estate is not deemed as an asset class under the Financial Services Act. And this is why people spend all these time and years stuffing around never getting to point B, which is financial independence or replacing their income. So what you want to do is go from point A to point B the fastest possible way with the path of least resistance, which I'll show you exactly what that means. Now, definition of true wealth is very broad. It means different things to different people. And it's very personalized, but it's really doing what you want, when you want, with whom you want, whenever you want, as much as possible. And that you can tailor to your specific needs and wants. And you could be living in different countries around the world, driving different cars, boats, whatever your thing is, doing stuff with charity, building schools in third world countries. I'm not here to judge. Whatever your thing is, pursue that passion, because life's too short. Most people think if they work hard and save, they eventually become financially independent and free, which is complete rubbish, because most people end up dead broke on the government pension. And this is the single worst underlying belief system, which is currently responsible for 96.5% of all Australians retiring virtually broke. So ask yourself this question, and the first thing of making money is to take responsibility for exactly where you are. If you don't take responsibility for where you are right now financially, then you'll never be able to move forwards, okay? So if you're that person that blames others for the circumstances, you've got to rise above that, or you're going to allow those people to default you in a life of average income and eventually government pension. So if you were stop working right now and you didn't change your lifestyle, how long could you live off your current savings and investments? Forever? Next 10 years, 5 years, year, 3 months, or until Friday? Because do you know what? Reality is most people it's till Friday, right? I mean, we laugh about it, but it's true. Most people are living from paycheck to paycheck. And there's gaps in between that people use credit cards to fill in. So based on your current personal income, how much do you save? You should be spending at least 10% of your income on personal development every year. If you're on 100 grand a year, 10 grand a year should be in personal development. If you're on 40 grand a year, $4,000 personal development, until you get to exactly where you want. That means doing courses, whether it's stock market, cryptocurrency, selling stuff on Amazon, eBay, whatever your thing is, you might as well spend it, because your income will increase. Otherwise, you're going to be dead broke. And whatever you earn, you're going to spend anyway, because that's how it works. So you have to just prioritize where your income goes. And 10% is not a lot of money. So 10% you should be investing in your personal development, 10% you should be putting away into term deposits and capital guaranteed products, and 10% you should be giving to charity, church, whatever cause you believe in. Based on your current business and investment income, what's left over, and based on your current assets liabilities, what's your current net worth. So you've got to kind of liquidate yourself and work out, if you sold up everything you have, how much is that worth? And that's exactly where you are financially. That's your point A. And then you've got to work out, well, what do I need to do to get to point B? And that's what I'm going to show you how to calculate that today. So you've got to ask yourself these questions. How old are you now? What age do you expect to retire and stop working? And I think a 10-year plan is really realistic, 10 to 15 years. Remember, some people will get there earlier, some will get there later, but that's a really good plan to have a 10-year plan. Now, if you get there 1 year later, you're not going to be suicidal. You'll still be very happy with your results. And what assets other than your own home do you need to acquire by then? That's the $1 million question. And I'm going to show you just with 5 investment properties at $795,000 each, how you can replace your income and generate $78,000 to $100,000 every year. For the rest of your life, indexed. Well, above indexation, because rental yields actually go up faster than inflation in specific suburbs. And you've got to be really specific about what income do you want to live on. Now, if you're on $300,000, you can put $300,000, because you'll have more equity, more serviceability to get there. If you're on $50,000, just do 50 as a starting point. It doesn't make a difference what it is. It's just achieving that goal, and then once you achieve that goal, you got to progress to the next level. Remember, if it gets measured, it gets managed. If it gets measured, it gets managed. If it doesn't get measured, it doesn't get managed. So you're just going to be blown around in your life like a paper bag in the wind, which is what most people do. They're just too busy. And they kind of live on autopilot. They're so busy at work Monday to Friday, then kids on weekends, footy practice, ballet, swimming, whatever the kids do. And then suddenly you're just wrecked on Sunday. You just want to kick back on the couch with a bowl of Maltesers and watch Married at First Sight. Now, if you're doing that, you're going to go through life paying a shitload of tax and eventually going to end up dead broke on the pension. So if you just tweak a couple of things, and I'm not asking for you to give up all your weekends, I'm just saying if you tweak a few things and prioritize your time and divert your tax dollars into property investments, you can have massive, drastic change occur in your life. Now, we've got to set up a kind of a rough guide of what constitutes financial independence in terms of money, because these things mean different things for different people. I know people that spend $2,000 for their cars per week, so forget about, they wouldn't be able to eat or live or sustain any kind of life on anything less than $6,000 per week, and I know people that don't even spend it in a month. For me, this is, by the way, I just made this up based on my experience. I haven't got a resource for this, but really just in Melbourne, broke is $400 net a week. And this is $400 in your pocket after your mortgage has been paid. Just getting by is $600 a week. Moderately secure, $800 a week. Independent to me is $1,500 a week after all my loans have been paid. So that's pretty much, that's after tax in your pocket. Pretty much you've got some, moderately secure, independent kind of situation, which is what I'll kind of target today's presentation on. Financial freedom, $3,000 per week, net. Wealthy is $5,000, and then the rich, $10,000 plus. I've spoken to a lot of millionaires, and I'm talking about person that lives in the $3 million house has $1 million in the bank account. I'm talking about people that are liquid, 200 million, 300 million, people that have real, some of these developers that I work with that own these building companies and developing companies, they are liquid with worth 50, 100, 200 million dollars. A lot of them actually in the BOW, top 1,000 richest people in Australia. And I asked them about their lifestyle and about, how much they spend. And beyond their house and their cars, most people don't actually spend that much money. And you'd be surprised that a lot of billionaires actually live very comparable lives to the average person. The only difference is the cars and the house. The house is usually paid off, there's no mortgage, and the same with the cars. They usually pay cash for cars. But beyond that, like in terms of daily operational, where they go for coffee, lunches, clothing, it's pretty much comparable to the average person. I have seen some that jet set around the world because the business takes them all around the world, and they do spend tens of thousands of dollars per year on flights and hotels. But the people that are based in Melbourne, that are just actually built in Melbourne, it's not that different from the average person. But I've put $10,000 per week net as the kind of guideline. So once you have that, you've got to kind of work out, so the aim of my financial life is to earn a passive income of, you can do this at home when you're watching this, just write down what number works for you. What's your walk away money from your job? That if you had that coming in every single week passively or on a monthly basis, you would quit your job, because most people hate what they do for work. There's very few people that I meet, probably 30%, that love what they do for work. And I asked them, the test is the Powerball test. If you won 50 million tomorrow, would you still go back to work on Monday? And for 70% of people go, yeah, right, no way. 30% said, yes, I actually love what I do. I would still go back. I probably would have worked full time, but I'd still be involved, which is cool. So they're very lucky people. It's very few people can say that, honestly. Now, how many years do you want to start living your extraordinary lifestyle? I'll just put 10 there. I would do a 10-year activity, but for you, if you're ambitious, do 5. Or if you're super conservative, do 15 and 20. And then you've got to be able to re-engineer that back into property acquisition. So I'll show you how to arrive, first of all, at the net asset base that you need to have secured in order to derive that rental income. So you put your number in there, divide by 52. For example, $2,000 per week times 52 equals $104,000 per year. So you've got to have $104,000 per year coming in, which equates to $2,000 per week, right? Very simple mathematics here. This is kind of year 7, guys. So if you can't follow this mathematics, I don't know whether property investing is for you. Multiply that by 2, okay? Use the calculator. 104,000 times 2, 208,000. And then take away 30%, which is really a rough way of calculating how much tax you pay on that. So 208,000 minus 62,400, which is 30% of the 208,000, gives you 145,600 per annum, or 2,800 per week after tax. And I've allowed a gap in there, but that's roughly what it equates to. So if you can get 150 grand a year, roughly you're going to have about 2,800 per week after tax, which will give you that $2,000. You always need to leave a buffer as well, by the way, because then if you don't get there, or if one property has more vacancies or something happens, you'll still arrive at your objective. So always put a 20% buffer in everything that you're doing. Now you multiply that by 20, the 145,600 by 20 gives you 2.91 million, and round it up to 3 million. So if you end up with a $3 million paid off properties, unencumbered, at 5% rental yield, you're going to get about $150,000 per year income. Now you might say, well, I'm not going to get 5%, I'll get 4%. Well, 4%, you just need to increase your asset base. 4% you end up with 120. So you need to end up with 300,000 unencumbered property portfolio to live 150 grand passive income per life. These are very broad figures. I'll show you how to get into specifics, but you need to start kind of developing these numbers in your mind and visualizing these numbers, and then visualize how to work back and translate your objectives into property acquisition. So this is not an activity in mathematics. I'm just showing you the psychology behind this process that you need to start thinking on, and then you have your walkaway money at the end. So remember, whatever resonates with you, whether it's 1,500, 3,000, I'm just going to show you the average income, which is around 78,000 to 100,000. We can change that. Now remember, there's 4 critical stages of building your property portfolio, and I talk about this through my YouTube channel, and I've done multiple videos on every topic. The number one is psychology, which is 80% of the equation. Your mindset, your psychology will make or break you. It's that simple. If you have a fear of debt, or which comes from a lack of education, you're always going to justify why it's the wrong time to invest in property. And you're going to find really good reasons why it's always the worst time to buy. Maybe I'm overpaying. Maybe I've missed the boat. Maybe my kids need braces. Maybe there's uncertainty with my partner's income. Blah, blah, blah. There's all these thousands of reasons. But you know what? The best time to invest in property was 10 years ago. Second best time is today. Psychology will determine whether you take action or whether you're inactive. And it's all based on your subconscious level. Your subconscious feels uneasy about taking on a mortgage, and your logical brain will find reasons to justify it. I see it all the time. I see it a lot with my clients where one partner, whether it's the female or the male, is very pro-investing, and then the other one puts the handbrake on, and they're not involved. They haven't been to the courses, they haven't read the books or education, but they're just like, no, it's the wrong time. No, we should think about it. I don't want to buy a townhouse. House and land. Maybe we should get a big block somewhere. Maybe Melbourne's already had its run. Let's go to Adelaide. Yeah, right. Let's go to Bulgaria. I heard there's some land being rezoned in Bulgaria. Maybe that's a great opportunity. So, you're going to have one person on really pro because they've got all the education and psychology, and the other one has no psychology, no information. If you have no information, you operate from a place of fear. And fear is, don't do anything. Don't change what we're doing currently. And look, to me, it doesn't really make a difference which one of you guys implements or not. I mean, I've already achieved my results. I'm just sharing this because I want you to become successful. My operational model is I come from a place of abundance. And I think everyone can rise up and become successful. Why struggle in life? It's unnecessary. But having said that, without psychology, you've got no chance of succeeding. You're actually going to be exactly where your parents are going to end up because that's the psychology you inherited. So it's very simple, guys. Either you shift your paradigms or you use the ones that you currently were given. And if you use the ones that you were given, look exactly where your parents are financially because that's exactly where you're heading 100 Ks an hour. Straight line, without any breaks. That's exactly where you're going to end up. So if your parents are multimillionaires retired with 15 properties, don't do anything. You're going to end up there probably as well. If they're dead broke, living on a pension, struggling, that's exactly where you're heading. So it's up to you. It's your choice. You've got to have a plan and a system, which we're talking about today is the plan and the system. This is what we're talking about in this presentation. And then you've got to have the right experts around you, which I've done many videos about who they are and how to leverage off them. And also selection property methodology, which I've also done many videos about how to choose the right areas and how to avoid areas. in Melbourne based on sound principles. So when these four things are synchronized, when you have the right psychology, the right plan, the right property selection methodology, and the right experts, that's the definition of success. If one of them is out of sync, you're going to fail in your property investing endeavors. You won't succeed. And the biggest one is psychology, and the second biggest one is plan. If you fail to plan, you plan to fail. The trouble is, as Buddha puts it, you think you have time. We'll do it next year or the year after or 10 years from now. And that time never comes. Now, there's three ways you can live off your property portfolio. You can live off your line of credit and capitalised interest, which I have done a video on before. You can also use your line of credit to trade shares, options, buy annuities, things that pay income or dividends or commercial property. Or you can sell a portion of your property portfolio, pay off the debt, and live off your unencumbered proceeds of your rental income. For example, you can buy 5 properties over a period of time, sell 3, pay off 2, and live off the unencumbered proceeds of the 2 properties. Or you can buy, a lot of my clients are buying 7, selling 4. You lose 1 in capital gain tax, by the way. That's why you sell 4, pay off 3. And you live off 3 properties, or buy 12, sell 7, pay out 5. So I'll show you how this works. You might be starting off with your principal place of residence, and then you get equity out through a line of credit or regional facility, and you buy your first property, and then the second property and third property, and then have a gap because you're maxed out in terms of your serviceability, and then your rental incomes to go up. And then what you do is you refinance the first investment property, and you buy another investment property and another one over here. So basically you've bought 5 investment properties over a period of 10 years, which is very achievable on anyone's average income. Now, it just depends on what price you're going to be paying for the properties. I mean, remember, there are properties in Australia in regional towns starting at $100,000, $120,000. In good regional towns like Bendigo, Ballarat, you can still get in at $450,000, for a decent property. I've even seen really good properties for $300,000. You don't need to go Melbourne Toorak for $3 million, okay? So there's a lot of options out there. The numbers all work the same way. It's just the mechanics of it that I want to share with you. There's 3 stages of your building phase. There's a building stage, which is the hardest. That's where you're getting all the knowledge, all the material, interacting with all your consultants, choosing all the properties. There's the consolidation stage, where you're making sure everything's working perfectly. Maybe you need to sell one property because it's underperforming. And there's a harvesting stage, where you're actually getting the rental income out, where you've sold your unwanted properties or the worst performing ones, paid off the best ones, you're living off the rental income, which I'm about to show you how that works. And your plan will vary depending on your risk profile. Some of my clients are buying 5 over 10 years, some are buying 7, and some are buying 12. I've got clients buying 3 properties per year. I've got a lot of dentists and doctors and high income earners, business owners that are on $500,000 to $1 million per year. They're buying a lot of properties, but the average person that I work with, the kind of $120,000 to $250,000 per year, they're buying 1 to 2 properties per year. So definitely in 5 years, they'll have 10 properties, 7 to 10 properties. Over 10, absolutely, without any problems. Now, so basically what I'll show you is how this works, and how this works just by buying 5 properties over 10 years. This is nothing drastic, guys. This is not taking massive risk, in my mind anyway. This is a very conservative approach to property investing. Now remember, Peter Drucker says what gets measured gets managed. Without this, if you don't put this in writing, if you don't measure things, you can't reach the objective. So let's say your desired income, and you can do this. This is another way of calculating your desired income. You can do this at home. Let's say it's $1,500 per week in today's dollars after tax. Multiply by 52, which is $78,000 per annum net after tax. Multiply by 1.6, which gives you the pre-tax at 37.5% tax rate. So that's $124,800. And then multiply by 25, divide by 4, which gives you $3.12 million. And let's say by 10 years. So if you end up with $3.12 million of unencumbered properties over 10 years, that portfolio, based on 4% rental yield, so I've kind of reduced the rental yield here, will give you $124,800 taxable income, which is $78,000 after tax. Now remember, these properties will have deductions like maintenance, council rate, land tax, all the other things that you get to depreciation on the building, fixtures and fittings, interest. So you shouldn't be paying full tax anyway. You should be getting closer to this figure than the $78,000 figure. But I want to show you the mechanics of that. Now, why have I'm going to choose $795,000 for these examples because I've got a lot of townhouses that I've sold over the years in all different suburbs in Melbourne, in blue chip areas, as well as areas that are going through gentrification that are $795,000. Like, for example, we just settled this last year in Footscray in Barclay Street. This was a development where 2 bedders were selling for from $675,000, and the 3 bedders, the front ones, sold for $799,000. So, really cool project, settled, did really well. Great developer, great builder. Three levels, open plan living with a courtyard, 2 bedrooms in the middle section, and then upstairs you have another master bedroom, built-in robes, and a rooftop terrace. So that's a really cool development, sold out. This is another one in Bentley that sold for $795,000. So these are the 2-bedroom townhouses in the McKinnon High catchment area, which is in the McKinnon High School zone, which is a really good public school, probably the best public school in Melbourne. And that they sold for $795,000. The front ones were 3 bedders, they sold for $1.28. Once again, great little project, great location, walking distance to Centre Road of Bent Street, walking distance to the train station. These are literally 2 bedrooms and an open plan living with a balcony. This is another one in Box Hill North, opposite the hospital, opposite the Box Hill Hospital, literally across the road. They also sold for $795,000, and this was also 2 bedders. So it's like an entry level. $795,000 is like an entry level into the Melbourne property market. Like, I don't really have anything under $795,000. Everything's kind of around $750,000 to $795,000 as a starting point. So if you want to work with me, by the way, all you got to do is get a pre-approval for $750,000, let's say, and I can definitely source some properties for you guys. This is all I do all day, is drive around, source these developments, get discounts from developers. This is my hobby. I'm very lucky because I love doing this stuff. Just this morning I had a 3-hour breakfast lunch with a developer in South Yarra. Developer's worth about $30 million. He's got a brand new Ferrari convertible that he bought, California, I think, worth $500,000. He's got 3 other cars, 2 of them are Rolls Royces. Lives in Toorak, caught up. He's got 7 projects on the go. 2 of them have passed my criteria, so I'll be selling them in the next 12 months. And I love doing this stuff. If I wasn't running Investors Prime Real Estate, I wouldn't be able to get to these people, because why would they randomly have breakfast with me? I mean, how weird would that be? Hey man, you don't know me. Do you want to have breakfast? Yeah, sure, I'd love to. How weird's that? So we have breakfast because we talk about which projects I'll be selling for them. So all I do as an agent, guys, is source these projects from developers and builders in Melbourne. That's why I do what I do. Now, let's look at the numbers. Specifically, I've chosen Box Hill North as an example, the $795,000, just to show you the mechanics of what it actually costs to secure one of these properties. So the purchase price is $795,000. Your legal and conveyancing are $2,500. Your stamp duty is $42,770. So $45,270 is what you need to come up at the day of settlement. $2,500 gets paid to your lawyer, and then the rest goes into the State Revenue Office. Now, you've got loan costs in there as well, like lenders' mortgage insurance, mortgage solicitors' fees, valuation fees. All these things are tax deductible for you over 5 years. So the $10,395 gets divided by 5, and you get to claim about $2,000 every year. You've also got, so you're doing interest only, 2.5%. So you're borrowing $771,165. So this person here has put in a deposit of $79,500, and they've borrowed the rest, basically. So just a 10% deposit. Your loan is $771,165. Your loan costs can be written down over 5 years, $10,395. Your monthly repayments are $1,607. Annual repayment just under $20,000, which is $19,279. The weekly rent for these is $550. Some of them have dropped to $500 because of COVID-19. But because they're across the road from the hospital, majority of them had doctors, dentists, or medical allied people renting them, and that sector of the economy has been affected a lot. So, I've been focusing on a lot of townhouses opposite hospitals in Melbourne. And look, my clients have done really well with them. Your number one tenant, guys, always is a doctor or a dentist or a couple of doctors. The worst tenant you can have, the worst, is mum and dad, 3 kids, 2 cats and a dog in a 4x2 house in the fringe suburbs in Point Cook or Pakenham. They will destroy your property, okay? But hey, you can have that experience. I don't want to take away that experience from you, because you learn through the most painful experiences in life. Smarter people learn from the mistakes of others, though. So it's up to you. It's your choice. So $550 a week rental. So 28,600 rental, 2% vacancy rate. So I'm allowing for this person to move out every year and then allow a couple of weeks of vacancy. So you're getting $28,028 per year in rental. Have a look at the relationship. You got 20 grand expenses, holding costs, and then 28,000 rental. Now, before we get too excited, you also have costs associated with the property. So you have, the biggest cost is obviously the interest only repayment, which is $19,279. But you've also got a property management fee, $2,158, which is 7.7%. Letting fee, which is to get your property listed on domain, realestate.com, and do the photos and description, which is $550. Council rates, $1,900. Landlord's insurance through Aon, $360 per year, which replaces your kitchen if they burn it down, or if they spill red wine on the carpet. It's all replaced and done for you. Body corporate's $1,500, which covers your building insurance and all the garden landscaping and the common areas and public liability insurance and the common driveway. And then also you have water connection fees, which is $170 per year. So your cash expenses associated with holding this property on top of your interest repayments on the loan are $6,638, which is 23.21% of your annual rent, which is cool. This number needs to be between 20 and 25%. Okay, no more than 25. Unless it's a service department, like you got gyms and stuff and it's security, then you can justify maybe 30%. But it should be, for a normal property in the suburbs, it should be between 20 and 25% maximum. So your net rental yield is 2.69. Okay, so you're losing about 1% there. It's about 3.75 before your costs. Now, you can also claim non-cash deductions like depreciation on the building and fixtures and fittings, which is the reason I do brand new property, because you get, not only do you get a warranty for everything over 5 years, manufacturer's warranties on air conditioners, dishwashers, hot water systems, but also you get the construction cost depreciated 2.5% over 40 years, which is $12,308 per year, and depreciation on fixtures and fittings, which is $4,210, plus the loan costs. So what happens is, in terms of your complete deductions for the first 12 months, you have $19,279 in interest repayments, expenses, which are your cash expenses that you're actually paying for, $6,638, depreciation on the building, $12,308, depreciation on fixtures and fittings, which is your cabinetry, your kitchens, your joinery, $4,211. You've got your loan cost, $2,079. So your total deductions for the first 12 months on this property, this is a real example, by the way, from a client of mine, is $44,516. Now, here's the coolest thing about this whole example of buying this property, this townhouse in Box Hill. And this is what Robert Kiyosaki talks about as the main distinction between the rich and the poor, where the rich pay for their investments with their pre-tax dollars, and then they spend what's left over, which is very little. And the poor, they get paid, the government takes their tax out automatically, and then they spend what's left over. They never invest. So in this example, this is a real client example. This particular person is a single guy on $120,000 per year that bought this townhouse. The rental income gets added to his normal income, so that $28,028 gets added to $120,000. He works in IT. It's a real client. So his income goes up to $148,028. But before he pays tax on that money, he gets to claim all the deductions, as previously mentioned, which is $44,516. So his new taxable income goes down to $103,512. The current tax that he's paying on his old income of $120,000 before he had the property is $34,747. The new tax on the reduced income, after claiming all the deductions associated with the property, is $28,317. So the difference between numbers is 6,430, which is what the government, the ATO, gives him as a check at the end of each year. Now, you notice there that he's got 28,000 left over in taxes. So he's got about room there for about 5 more properties, because each property will eat up around $6,000 to $7,000. But obviously, every time you buy a property, you add rental income and then take away tax. So he's got room there definitely for about 5 properties before he has no more tax that he pays legally. So he can get his tax down to 0. And in fact, this person now is buying his second property in the second year. This is the property that he settled last year. He's bought a second property this year, and we're on track to buy 1 property per year and get his tax down to 0, which is really cool. So that's $6,430. What happens to that money is, and I'll explain how this whole works. I know we're getting into a lot of numbers here, but it's important for you to stay with me and even watch this section a couple of times, because this is the essence of the mechanics of how the whole thing works. So it's a property for $795,000. In year 1, based on 8% capital growth, and the area is already growing at 8% for the last 20 years according to RP data, you've got equity of $87,435. The rent's $28,028 per year. The total deductions are $44,516. Do you notice the deductions are diminishing because your depreciation on the fixtures and fittings is getting smaller and smaller? If this person was not working at all, he had no income, okay, so he's currently in IT, he had no income at all and no Centrelink income, this property would pay for itself by $2,111 per year. So after all expenses associated with holding this property, council rates, land tax, everything, there'll be a distribution of $2,111 per year in his bank account after all expenses. So he doesn't need him and his job to maintain the property. He doesn't need to add anything to the property. Because he is working, he also gets a kickback from the ATO. Not a kickback, okay? Don't email me. Conrad's saying the ATO is giving kickbacks. Okay, he's getting a tax refund. People are so pedantic these days. Anything I say on YouTube now, it's, there's 10 emails. You said this and it's not accurate. It's not a kickback, okay? It's a tax refund of $6,430. So combined, the property's cash flow positive by $8,541 for the first 12 months. And it keeps going up. Now, you notice that the tax credits come to an end around about year 7 because the property, the rental exceeds the deductions, which means it's cash flow positive by even depreciation. And therefore, you don't get any kickbacks. So you got to just keep, not kickbacks, refunds, okay? Refunds. So you got to keep buying properties in order to make sure you get all your tax benefits claimable perfectly. Now, the cool thing is, when do you buy your second property and how do you buy your second property? Well, in year 2, based on 8% capital growth, we've got equity of $156,000. So he will take 80% of that out, okay? Which is whatever, 120,000, 130,000, and he's got a deposit there for another townhouse. He'll do the same thing in year 4 and in year 6. Now remember, here you're buying your second property, but in year 4, not only do you buy a property here, but you buy another one from the other property. So you're buying 2 that year and then 3 that year. So over 10 years, he'll be able to buy 7 properties maximum, which is incredible for a single person, $120,000. But that is the maximum he can absolutely do. Okay, that's the absolute, and it's all mathematically based. It's not like, because I feel like he can do 7 properties. Because there are restrictions based on serviceability, DSR ratios, credit scoring algorithms, all the other stuff I talk about in my other YouTube videos. And then maybe in year 8 we can go again, but I don't know. No one's got a crystal ball. The thing about this property is this. If he just continues to hold on to these properties without ever paying debt off, so never paying the original $795,000, a property in year 10 would generate $19,026. So you get $19,000 cash after all expenses from each property. Let's call it 20 grand. So you've got 5 properties, that's 100 grand. 6 properties, 120, okay? If you were then to sell, if you were to have a property unencumbered in year 10, it would generate $47,000, okay, in income, or $50,000 in year 11. Let's call it 11, okay? So let's allow for 11. So if he ends up with 2 properties paid off in year 11 and 12 and 13, for example, by selling the last few to pay them off, he'll end up with $100,000 with no debt. So either you can keep accumulating your properties and they become cash flow positive. So in this example, $19,026 in year 10 with the original debt of $795, so you never pay off the debt. Or you can buy 5, sell 3 and pay off the original 2. In this example, every property you pay off gives you about 50 grand rental income. And that's how the whole passive income works. So this is there's no magic to these guys, it's just mathematics and understanding methodology. I mean, people talk about secrets of real estate super rich. I've met the rich and there's no secrets. It's all this stuff, you know. They don't meet somewhere in Turak every Wednesday night and go, okay, let's keep all the secrets to us, okay? It doesn't exist. It's just mathematics and knowing what to do. So really you have the option of either paying off your properties and living off 50 grand each with no debt, or just keep accumulating. Now he's very young, he's about 28. He's got 30 years of compounding ahead of him. There's no chance this guy's going to pull the pin. He loves IT as well, and he loves cryptocurrency trading, which he dabbles in. I'm sure he'll be around in IT somewhere or another for a long period of time. So this is really what it will look like. If you're buying $795,000 properties, in this example, I'm just going to do an example without any compounding. So I haven't indexed them or I've allowed for 8% capital growth. When I do that, it looks like this, okay? So I want to show you the mechanics of buying 1 property per year, or buying 5 properties over 10 years, as I mentioned before. And this is what they look like at 8% compounded capital growth, okay? So what we're doing here is, in year 1, we're buying 1 property. In year 2 and year 3, we buy 3 properties. No purchase, and we buy another 2, 1 in year 6, 1 in year 7. So you're starting off in 2022, you buy a townhouse, 23, 24, and then you buy the same property in 27, 28, okay? And then no purchases. And then what you do is, when it comes over here, which is 2032, another 10 years, these properties here, this is the value of these properties. So the 795 is worth 1.716 million. The 858, 600 properties worth 1.854 million. And then this property is worth 2.2 million and 2,000. So what you're doing is, you sell these 3, you're effectively selling these 3 that you've purchased originally, and you're paying out these 2 here, okay? So you've bought 5 properties, you sell the first 3, pay off the last 2. The last one you sell in 2034, okay? So it's really effectively, we're in 2021, it's a 13-year plan. And then you probably want to sell down 1 year to minimize capital gain tax, okay? But you will have to pay capital gain tax. 2 things in life you can't avoid, death and taxes. They're coming one way or another, okay? Now you can defer them, but eventually they'll come, guaranteed. So if you pay off these 2 properties, okay, by the way, these 2 properties here, they're worth 1.7 to 1.8 million individually. You lose this one in capital gain tax, even though you made money on it, you made over $1 million, that $1 million will disappear in capital gain because you've got to pay for all of them. The money just got to come from somewhere. So effectively what happens is you end up in year 2034 with these 2 properties here paid off completely, okay? And they're worth, let's say 1.7, 1.8. So what happens is effectively in 2032, you have 2 investment properties, 100% paid out. That's if you sell all 3 in the first year, which I don't recommend. You probably want to stagger your sale. So you've got 1 property with 1.716 million, and then you've got another one 1.854 at 2023, 2032. They're unencumbered, so you're getting 4% rental yield, okay? Which is $102,467 per year. Sorry, it's $142,800 per year minus tax of $40,333, which is $102,467 after tax. So you're getting a passive income of $102,000 out of these 2 properties, basically 50 grand each, like I mentioned before in the other example. So this is, as we mentioned before, over here, you're getting around in year 10, around 50 grand in income for these properties, or less than half if you have the original debt still owing on them, okay? So buy 5, sell 3, pay off 2. Or you could buy 7, sell 4, pay off 3. Or buy 12, sell 7, pay out 5, depending on how much income you want. So in your mind, just think about an $800,000 townhouse, around 50 grand in passive income if it's paid off in year 10, or 20,000 if it's encumbered. Because you've got to have these round figures in your mind, and that's how you work out your plan and how to document everything. So if your desired income is $1,500 per week, as we mentioned before, times 52, which is $78,000 per annum after tax, which is $124,000 before tax, you need to end up with $3 million unencumbered property, 3.12 in year 10. In this example before that we did, we ended up with $3.57 million of unencumbered properties based on 8% growth. Now you might say, well, 8%, is that realistic? There's some that have done 10%, but if you're conservative, do your numbers at 6. Like, the numbers still work, it'll just take you longer to get there. And if you get there sooner, then you're just going to be happy and more fulfilled. See, it doesn't matter when you get there. All that matters is that you've got your starting point locked in and your end point. It's like going from Melbourne to Geelong. Okay, it's about an hour and a half to 2 hour trip, depending on what you drive. And I drive fast. But when you might be diverted halfway through. You might be taken through exits or ramps that are closed and diverted. You'll get there eventually. Okay. The most important thing is not the time, it's the destination has to be locked in. You've got to have this number in mind of this income that you want to have out of your property portfolio. Otherwise, you're never going to get there. What's the point of doing it? Now, once you reach that income, then you can go again, reassess your goals and go higher. So once you get 100 grand, let's say, well, now let's go for 150, 200. You know, it's got to be things that you can believe, number one, so it's got to be realistic to your wage. Don't go, if you're working on 60 grand in the post office, don't go, I want to get 10 million a month. Well, your brain's not going to accept that, okay? So it's got to be realistic but ambitious so your brain can actually accept that it's real, okay? So don't go for ridiculous figures because it's a stupid thing. You'll never get there. By the way, you could get there. You could become an owner of Amazon or equivalent. So I'm not here to challenge what you're going to become, but I'm saying a lot of this stuff is based on mathematics. You can't really break the rules here. You can increase your income, which affects your serviceability, but if your job will be the same for the next 10 years, if you're not planning to change your profession or open up a business, assume your income is going to be the same, index your income, and then base your income objective on your income, okay? So I'm not saying don't be ambitious. I'm saying, yeah, be unrealistic, but really, you know, be comparable to what you're earning. And then once you achieve that objective, set the next objective higher. Okay? It's great if you get there earlier because then you can set your goals even higher, you know? So basically, what will money do for you? Money won't change you, guys. Money's a magnifier. So if you're a good person right now, you're going to be a better person. If you're doing charity work right now, you're going to be doing more charity work, giving back to people. If you're a bastard right now, you're going to be a bigger bastard. That's all that it's a magnifier for who you are. Money doesn't change you. It doesn't change you at all. You know, like looking back at my life, there's a lot of stuff that I wanted to buy in my 20s that I couldn't afford. You know, AMG, Mercedes Benz, and I'll tell you, once you get them, you get the watches and the Beamers and everything. You're happy like for 7 seconds. Do you know what I mean? It doesn't really add that much difference to your life. And then you just get paranoid at shopping centres when you park these things. So you just park like away from everyone at the end. So the difference between me today is when I park my $250,000 Mercedes Benz, I park it 2 kilometres away from the shopping centre. Actually, I Uber most of the time to shopping centres because I've seen people open car doors just rang. You know, so I can't park next to the front door. When I had really bad cars in my 20s, I would park right at the front because my car was the worst car out of all of them. So I wouldn't care about my doors getting damaged. So once again, you can live off your property portfolio through living off your line of credit, capitalising the interest. Use your line of credit to trade shares, buy annuities, commercial property, industrial property, whatever your thing is. Buy Bulgarian property. Don't send me emails, okay, if you're from Bulgaria. I'm not mocking the property market there. Or you can sell a portion of your property portfolio, pay off your debts and live off a debt-free property portfolio for the rest of your life, which is really cool. Couple of things about structuring. Now, I'm going to do another video on this this year, and I've done others previously, which I'll change and I'll build upon. But I want to mention just this fact before we wrap up. How do you structure your property portfolio? Number one is, this is bad debt. Your house that you live in is bad debt. It's non-tax deductible, interest-only debt or P&I debt. These are good debts. So you want to be paying off your house, accumulating good debts. You don't want to be paying off the debt by physically making additional repayments. You want the structure to pay it off for you. Very specific distinction. All have to be standalone. Never cross-collateralize your assets. Set up your lines of credit when you can, when you've got equity in them, and have buffers in place. Okay? Use trusts. The rich use trust. The rich control assets that own assets directly. Now, if you're in IT and you're paying like that gentleman before, probably after getting independent financial advice and accounting advice, which he did, he's buying the first 4 properties in his personal name because he's in a very non-litigious industry. He'll get his tax down to virtually zero or a very acceptable level, and then he'll buy everything in trusts. The ones he'll sell will be the personal ones, the ones he'll hold will be the trust ones, okay? Now that's a very specific advice based on his specific needs, based on his specific discussion with a financial planner and an accountant. And that was based on the discussion with James Black from Branding Co. and Dennis Duran from Fortune Financial Planning. I'm not giving you advice here. Other clients who are doctors have everything in trust. They don't have anything in their own personal name because they're in a highly litigious industry, i.e. they're paying a lot of public indemnity premiums. So you've got to work out with your consultant what is the best methodology and structure for you to move into using when you're building this property portfolio. And it's going to be done beforehand, okay? Not afterwards. Afterwards, you can't transfer assets. You're going to pay stamp duty and potentially capital gain tax. So remember, the rich control assets. They don't own assets. The poor are obsessed with owning shit outright, okay? So you need to control everything, own nothing. So when you get sued, nothing happens. Otherwise, it will be a domino effect. That's what asset protection gives you. It gives you that separation of ownership between your house and your investment properties. You never risk your house, guys. Never cross-collateralize your assets. Never give personal guarantees for anything. It's crazy. Wherever gets grouped together dies together. Always remember that. So everything's through companies. Company has 2 directors, appointers, and then you've got a trust. And it's a discretionary trust or a unit trust. This is how you buy all your properties. Okay? You never ever have things in your personal name unless you want to get rid of your tax and you're not in the litigious industry. Okay? Personally, I've got nothing in my personal name. Everything's in trust. And remember, in this example, he's already, in this particular example, $120,000 per year, he's got $28,000 left over in tax. That's why his decision was to do the next few in his personal name. And look, in IT, he's doing coding as part of a large team. There's no interaction with the public. Chances of him getting sued are very slim, okay? So that's his decision, and this is what he decided after having that discussion with the accountant. And the other good thing is when you do things in your personal name, you get to claim this tax credit against your job income. Otherwise, in the trust, these amounts here get deferred and quarantined inside the trust, and they get treated later on when the trust distributes income. Okay? So there is a delayed effect with negative gearing inside trusts. I don't want to get too complicated because I'm jumping into another topic here. This is the whole machine, guys. So you should be very familiar with this particular structure. If you're not, I recommend that you buy a copy of my book, which is Australian Property Finance Made Simple. It explains this structure. This will save you. Look, guys, listen to this. This is a one-day read, okay? A very slim book, one-day read. This will save you 10 years of your mortgage, hundreds of thousands of dollars. If you were to take a day off sick and just read this book, that's the best time that you can spend as an individual. I mean, what's your hourly, if 100 grand over 10 years of your life, how much is your hourly rate? 10,000 per hour? Imagine I paid you 10,000 an hour to read my book. It's the same thing, isn't it? You're saving 100 grand off your mortgage or more. So if you don't know how this works, you need to understand this structure. I mean, I've done YouTube videos on this. You can read my book. There's a course that I've got for free that teaches this methodology. But effectively what you want to do is have your home with one of the majors. You have multiple offset accounts. Each offset account correlates only to one investment property. All these properties are in trusts, okay? If you have a business, everything needs to be separated. If you're a plumber, your plumbing business is in a separate trust compared to your assets. So if you get sued here as a plumber, okay, it doesn't spill over to your house or any other assets. Everything is separated. Any good accountant and good financial planner can set this up for you. You just need the right advice, okay? This is the machine. This is the thing that will make you more money than anything else, is optimizing your investment structure. That's it for today, guys. I hope you enjoyed that information. Now, by the way, for a lot of you, I hope I've given some clarity and direction. And for some of you, if you're ready to take the next step, I encourage you to book in a 60-minute consultation with myself. I do about 5 to 10 of these per week. I am getting booked out now about 3 weeks, 4 weeks. There's a bit of a waiting list. And I do only 2 a day, at 2 o'clock and at 4 o'clock. And it's only with people who want to build their wealth using properties in Melbourne. So if you want to do any other strategy like renovations or buy something in WA, I can't help you. It's only for people that want to build up their wealth by investing in the top 50 best, highest capital growth suburbs in Melbourne. I can definitely do a plan, and I can do a Zoom meeting with you for an hour and develop a whole plan and basically give you my thoughts about where you currently are. What's the fastest way to get from point A to point B? Tailor-made. If you fail to plan, you plan to fail. So in the consultation, rather than doing this, I've got 25 years experience doing this one thing, which is getting people from A to B. And I've done it myself. So I'm there to guide you, to give you insights, and I'll give you my whole contact list of my accountant, my financial planner, my lawyers. It's a 1 hour personalized strategy session. It's free. There's no obligation. There's no charge or anything. If you ever want to give me money, feel free, just send me random bills, or I could meet you at a park bench somewhere and you can just put cash in a brown paper bag and no problem. But this is free, in all seriousness. There's no charge. I'll give you a personal introduction to a top broker, top solicitor, top accountant, top financial planner, top property manager, the whole team in Melbourne. You'll get priority access to my developments that I'm sourcing for private clients. It's worth just having this whole list of experts in Melbourne. If you're Melbourne-based, it's a no-brainer, and they service people all around Australia and internationally. These accounting firms look after people in Dubai, in Vietnam, in Malaysia, everywhere, in Singapore. They've got clients internationally. It's a journey of building wealth step by step, paint by the numbers. Okay, so it's going to be very specific information that I'll give you after I get an idea of where you are, where you want to be. And the minimum requirement is you need to be able to purchase a $700,000 property, $750, let's call it now, it's gone up a little bit. So if you're a single person, you need to be about $95,000 per year. Otherwise, therefore at 90%, including mortgage insurance, you can buy a property like a townhouse in an up and coming area, and you need to have $112,000 in equity. Or 126 if you're going 90%, including LMI. So if you're on about 100 grand, yeah, we can work. If you're on like 50 grand, I can't help you. I don't have any properties that I'll be able to source for you, unfortunately. If you're a couple, 80 and 60, it's about 120, 140 grand is fine. And same thing, equity of 112,000 in cash or equity accessible in the property, or $126,000 if you're going at 90% plus LMI. That's just the minimum requirement to get into the first property, and then we can work from there. The hardest thing is to get the first one done, and the hardest thing is to get the first one structured correctly, which I'll guide you step by step. Literally, I'll tell you exactly what to do, how to structure it, who to go to, the whole thing. I'm like a concierge for property investors. So for those who are interested, just send me an email, conrad@investorsprime.com.au, and just say that you'd like to book in a 60-minute strategy session with myself, and I'll just reply to you with some times where they can work for both of us. There's no obligation, and I love doing these sessions. I really love talking to you guys because a lot of you are so serious about property investing, and you might have been wanting to invest and been thinking about it for 5-10 years, and you just don't know how to get started, or which property to buy next, or which area to target. And that's why I can give you a lot of clarity. I know the Melbourne market back to front. I'm in the market every day, talking to developers, builders, sourcing properties. I know every suburb in Melbourne, guys. I know all 420 suburbs. Not at the micro level, street level, having coffee there, talking to locals, talking to developers, councils, and macro level, API data, charts, graphs, stats. Okay, so I'm a Melbourne expert, and that's all I do all day. I love this market. I know exactly what's going to happen in Melbourne next 12 months, 24 months. And if you listen to my YouTube videos in the last 4 years, I've been very accurate in my predictions. So that's it for me, guys. I hope you enjoyed this video. This is Conrad Bobilac, and I'll see you on the inside.